Is it time to buy more Alibaba stock? The stock is rocketing following their most recent earnings results. But the reality is, you look back over the last year, it's still crushed, down around 60% over the last 12 months. In this video, I'm going to share my thoughts on Alibaba's most recent earnings update, the good and the bad, because it's not all gravy. It's not all great looking at their results. And what are my thoughts around the valuation? Because I personally own shares in Alibaba, and I'm trying to figure out, should I be buying more? What do I think of the current share price and the potential? We'll talk about that towards the end of the video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right into Alibaba's most recent results. And so looking at their earnings results, you can see not crazy growth. Their China commerce segment, 8% growth. A lot of this driven by lower margin business lines. International commerce, which, this is outside of China's business, only growing 7%. So you can't blame that on Chinese lockdowns, in response to COVID. This is broader weakness that they're seeing in international operations. Even their cloud segment is not posting the growth that a lot of folks previously thought, myself included, thinking, hey, maybe this could be 20, 30, 40% growth as far as I can see. Now they're posting in closer to 12%. We'll talk about each of these core segments in a bit, and I'm not even covering some of their other bets like local consumer services, as well as logistics, digital media, and entertainment. So there's a lot of things going on here. Looking at their adjusted profitability that, sort of removes the one-time impacts of things like anti-monopoly fines that were imposed last year, their profitability still declined by about 30% year over year in the most recent quarter, about 23% decline on a full year basis. So this is not, crazy great results. So if you might be looking at this saying, well, wait a second, if these results aren't so great, why is the stock bouncing higher? I don't quite get it. And so that's where it comes down to expectations. Expectations, I think, had baked in that Alibaba is just going to disappear, that this company is going to collapse. And the reality is, at its current price, even with huge cash burn in the most recent quarter, even with the cash balance going down slightly, largely because they're buying back significant amounts of stock, even with them investing in all of these unprofitable segments, they still generated nearly 100 billion RMB in free cash flow. And so that means that they trade around 13 times free cash flow adjusted for their net cash balance. So that is really, I'd argue, just a really favorable or even cheap valuation. And when you get a company post, hey, we can have just slight growth, we're going to actually keep having free cash flow, then it causes investors to go, wait a second, maybe you start getting real value investment support. Is it really worthwhile to sell something at 13 times trailing free cash flow? Not even something that where you're projecting it 5 years out from now, with a lot of sort of costs that are already baked into that free cash flow. All these investments that they're already making, those investments turn around, free cash flow can grow even faster than sales in the years ahead. So you have these dynamics at play looking at Alibaba's most recent results. They're also buying back a lot more shares, so becoming more shareholder friendly. This is definitely very favorable development. Last year buying $9.6 billion in stock in March 2022, saying they're upping their game, saying, yeah, we're taking our share repurchase program from 15 billion to 25 billion. And you're starting to see it with their share count down about 3% year over year. That buyback is starting to work. That's what I like to see. Now, looking at the individual segments, like their China commerce segment, it wasn't great. Their customer management segment, which is the vast majority of their profitability tied to Taobao and Tmall, reported effectively a decline, a low single-digit decline year over year in online physical goods. So if this is their cash cow, no wonder why their results are coming under pressure. Now, part of this is competitive because clearly other e-commerce platforms are growing in China, but also they talk about the impact of COVID-19. They're also looking at growth. So yeah, they did post 8% growth for their China commerce segment, but this is coming from lower margin direct sales businesses that arguably this is the reason why you're seeing their profitability go down. Now, if you look at international, there's a lot of different pieces here that ultimately drove, I'd argue, not great growth, only 7%. So you have a couple of different moving pieces where you have the depreciation of the Turkish lira against the renminbi, a decline in orders of AliExpress, which was due to the ongoing impact from the change in the European Union's VAT rules. So if effectively, if you have a tax exemption that no longer applies, you're going to get less business. And there were also some supply chain and logistics disruptions because of the effectively the war in the Ukraine, or Russia invaded Ukraine. And so you have these different aspects that are impacting their international segment. So I don't look at this as saying, hey, this business is structurally impaired. Yeah, it's still unprofitable, but it is possible that you see some sort of growth resumption in the quarters or years ahead. Looking at their cloud segment, this is the third core segment that I want to focus on in this video. Looking at it, the growth of 12% really surprised me. Once again, I expected this business to be able to reaccelerate. They had previously talked about how they had lost one major customer and that had sort of held back their growth, but seeing continued deceleration isn't great. Overall for the year, still up 23%. They explain the arguably mediocre results attributed to reflecting slowing economic activities. And you're seeing this theme over and over again, that China is coming under pressure, softening demand from customers in China's internet industry, and delays in completing hybrid cloud projects due to the impact of COVID-19. That said, looking at this, they did post their first adjusted EBITDA margin profitability. So this is a good data point to see. You see it for the full year as well. So heading in the right directions. This once again reinforces the idea that free cash flow could grow faster than sales in the years ahead, which is a real possibility. And so this is an interesting data point. Looking at this, nothing here is saying, hey, your business is, let's say, getting crushed. What they're saying is, yeah, this is a competitive aspect. Now, here's a key aspect that I think is another reason why the stock's rebounding today, which is their guidance. They're effectively saying, yeah, it's really tough out there, significantly affected by COVID-19, the lockdowns, but the company will continue to generate strong operating cash flow to maintain strategic flexibility. I.e., this company is not going to disappear. Alibaba is still a behemoth. We're still going to generate real operating cash flows. So this is going to be a business. We're not going to invest it necessarily all in unprofitable ventures, and we're not going to burn up all of our cash savings. So this is a key aspect, saying, look, we're going to calibrate our operations against changing economic and competitive circumstances. They're still looking for sustainable, high-quality revenue growth and optimizing our cost structure. So this is the data points investors want to see, saying, okay, this cash burn we've recently seen, you're aware of it, you're going to be mindful of it. There's a good chance that you might start turning that around in the near future and hopefully start boosting your free cash flow even more, because there was that huge decline in free cash flow this last year. It trades at only 13 times that discounted free cash flow, arguably, like how much. Even though free cash flow is down significantly, it only trades at 13 times that, and there's this potential for free cash flow to rebound as they optimize their cost structure. So these are the data points investors want to hear, want to see. So the question is, what's the right value for Alibaba stock? Because the stock price certainly has been jumping around all over the place. First, a quick plug where if you're either struggling with this current investment environment where you're just trying to protect your savings, or if you want to find potentially unrivaled investments, hopefully the types of stocks that could potentially go up hundreds or even thousands of % over time, go to unrivaledinvesting.com. A big thank you to all the Unrivaled Investing subscribers that keep this channel going. If you're not yet an Unrivaled Investing subscriber, I do appreciate you hitting that thumbs up or hit that subscribe button. And so looking at Alibaba, also full disclosure, I do own shares in Alibaba stock. This is not financial advice. I do own shares on the Hong Kong exchange, which I purchased using the Interactive Brokers platform. There's a link to Interactive Brokers below in the description of this video if you're interested in learning more about their platform. And so here it is, looking at Alibaba, thinking about, is the pain over? They did have this really interesting comment in the most recent call, saying the Chinese government has released important policy signals on its commitment to stabilize the economy and the job market in response to COVID impacts. So they're aware that the recent lockdown initiatives in response to, COVID, this is really hurting their economy. So they're saying, yeah, we need to stabilize the economy. The economy's in trouble here. This is the reason why arguably their core results are coming under pressure. They also issued clear statements on promoting the development of internet platform economy through a healthy regulatory environment. Yesterday, the State Council held a national meeting to mobilize the implementation of several economic policies. So this is worthwhile data point to sort of think about. This means that instead of, let's say, the Chinese Communist Party hurting and over-regulating the industry and creating more pressures, additional fines for Alibaba, there's a chance they're taking their foot off the pedal there in terms of heavy crackdowns on these core businesses and saying, hey, is this proper growth, healthy growth for the economy? Is this enough? Have we done enough? So are they sort of flipping from being a net sort of detractor, a pain for these core businesses to saying, hey, we are actually going to start helping you out by saying, hey, the economy needs to stabilize. We might start injecting some stimulus or more favorable monetary policy. So looking at these developments, that's a key. This could be a turn in the tide. Now, it is worth understanding with China, with geopolitics, there are certain flashpoints there. So any analysis of looking at a Chinese stock, you need to be mindful that if any of those flashpoints go off, that could derail your thesis. So I'm not going to go into all those different risks right now, but it is worth understanding that outside of a broader macro shock, we're looking at Alibaba stock thinking, hey, what's the potential here? And so let me talk more about Alibaba's potential, thinking about the share price in particular. And so look, here's a hypothetical valuation framework just for their China commerce segment. We're arguably looking at this business, which currently has over 30% profit margins, assuming margins continue to go lower for the segment, assuming effectively around 10% growth this next year, assuming a 25% tax rate for this segment. This is their only real core profitable segment. Cloud is just barely profitable. Looking at this, thinking about growth of, let's say, less than 10% over the next 5 years, annualized, what's the end multiple you want to give it? Let's say somewhere between 12.5 times to 17.5 times. And their China commerce segment is effectively worth either the entire current market cap or effectively 200% of the current market cap. So effectively suggesting over 100% upside just for China commerce segment. Or you could say just this segment alone is trading at 13 times, less than 13 times forward earnings. That is really, really interesting to me. Now, keep in mind, this is hypothetical. Of course, stock price can go way higher, way lower, not financial advice. A lot depends on their execution. If margins go way lower than 25%, which I'd be surprised about, but if that happens, then yeah, you'd want to revisit the thesis here. But looking at this saying, hey, this one segment, their core profit driver has over 100% upside potential, assuming only 10% growth and let's say at 17 times earnings multiple 5 years from now. That is interesting to me. And then you factor in, here's the mascot for their Taobao platform. You look at the fact that we're saying, yeah, value it only on this one segment, China commerce. Let's ignore international commerce, local consumer services, effectively their infrastructure platform, their cloud, their digital media and entertainment segments. Now, keep in mind, these are all pretty much unprofitable with the exception of cloud, but even cloud's not that meaningful. Do you think these things are worth nothing? Or do you think over time, these platforms could be worth a lot more? And I'd argue they could potentially be worth a lot more. Maybe their cloud could be worth a lot more. Maybe their international commerce could be worth a lot more. And I'm going to talk about some of the assumptions that go into it, my thoughts further on the valuation upside. I do think that there's at least 100% upside just looking at their China commerce segment. So I'm going to talk more about these other segments. There's only so much you can do in one YouTube video, but I'll talk more about it in my weekly letter for the Unrivaled Investing subscribers. But overall, looking at it, I am pleased with owning my stake in Alibaba stock. I'm not going crazy about it saying, go all in, but I am looking at, I'm certainly not looking to sell at this point because I'm looking at this and I'm saying, unless there's some sort of geopolitical flashpoint that goes off, this stock is arguably very, very cheap. And if, once again, there's not a geopolitical or macro shock, then I could see Alibaba well outperforming, let's say, some of the major U.S. indices over the next 5 to 10 years, just given how cheap it is and the free cash flow that they're starting to return to shareholders. Then overlay that with effectively a changing of the tide, potentially, from the government perspective, saying, hey, we're going from strongly regulating to now let's help support the economy. So if that, you see these different changes of tone, returning lots of free cash flow to shareholders. I like to see that. I like to see the share count go down. So I'm seeing these data points saying, yeah, this is interesting. Plus the stock price being down so much. over a fairly short period, a couple of years. So this strikes me as super interesting. I am still trying to figure out how much I want to add to Alibaba, thinking about it, because there are a couple of different, Chinese plays that I am invested in, looking at the sort of risk reward. And so if this video has been helpful for you, I certainly do like Alibaba at this point. So I'm making that clear, to everyone watching on YouTube. And so if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.